We have this phrase called tax incidence. Tax incidence refers to who actually is paying a tax. Now you're going, wait a second. So you go out to the store and you buy some clothes, and when you're leaving, they charge you 8.25% in sales tax. Is it actually you that's paying that sales tax? Is it the business that's paying that sales tax? Who actually pays it? So we have this term, besides this term tax incidence, which refers, we have another term called shifting, which means the person or business that pays the government, which is the business, right? When you go buy your shirt and you pay your 8.25%, you don't pay the 8.25% to the government. You pay the 8.25% to the clothing store, and then they pay the government. So does that mean you actually paid the tax because it's added on your bill? Does that mean they actually paid the tax? Shifting means somebody is able to move that tax onto somebody else. So it's possible that the business is paying the sales tax. It's possible that you as the consumer are paying the sales tax. It's possible that you're splitting it up somehow. And the question of who pays it is this question of incidence. And sometimes we intend a tax to be paid by somebody, and they can sometimes shift that off onto somebody else. So, how do we not pay taxes? Well, there's two basic not paying taxes. One is called tax avoidance. Tax avoidance is the use of legal loopholes or other means to avoid paying taxes. When Mitt Romney was running for president in 2012, he gave us his income tax returns, and he basically had $300 million that's sitting in the Bahamas. Well, Bahamas doesn't tax anything. And the United States can't tax something that's not in the United States. So all that money is sitting there in the Bahamas, and it's not taxable. If he wants to bring it back into the United States, then it might be taxable when it comes back into the United States. He's not the only person that uses the Bahamas. There's lots of people who use the Bahamas and lots of companies that use the Bahamas to avoid paying taxes. It's legal. It's absolutely legal. We might not like it, but it's legal. We also have something called pass-through corporations. Corporations get taxed in the current tax law, corporations get taxed at 21%. Rich people can get taxed at over 30%. So one way, and it's impossible for us normal people to do this, but rich people can do it. One way you can avoid paying taxes is to set up your business entities into a set of corporations. And so we don't really know the exactness of President Trump's taxes, but we know that 10 years or so ago, we got one page of his tax returns, and he owns 500 something of these pass-through corporations. That means if he just paid himself this money, let's suppose that he licenses his name on a golf course in England, right? So most of the stuff that has his name on it, he doesn't actually own. He just licenses other people to use his name. If he signs a contract and says, golf course in England, you pay Donald J. Trump, then Donald J. Trump has to pay the 30 whatever % tax rate that he has to pay on that. If, on the other hand, Donald Trump sets up a corporation, has the company in England pay that corporation, then that corporation only has to pay 21%. That money passes through that corporation, and by doing that, pays a lower tax rate. Okay? Legal. Perfectly legal. Okay? And again, if you were rich, you would do it too. Because why pay 39% if you can pay 21%? Okay? Tax evasion is the use of illegal means to avoid paying taxes. So if you work on the strip and you make a lot of tips and you tell the government you didn't make any tips, that's tax evasion. Many of the casinos in town, in fact, basically all the casinos in town, use a tip pooling method where when the tips come in, they have to be shared and then split up. Nobody gets to keep their own tips. And the reason is the government actually sent people in pretending to be and got jobs at casinos and tracked how much tips were actually coming in, and then started auditing people's tax returns. And to save all those people who work on the Strip from multiple embarrassment, they worked out a deal with the casinos so that the tips would show up on your paycheck and they'd be grouped together. Okay? While pass-through corporations are legal, money laundering is not. So there are ways that you can set up a corporation that's pretending to do something and making it look like money's being spent or not spent, and you end up with that money going from person A to person B. On paper, it looks like no money went from person A to person B, but lots of money did. There are countries that are really hotbeds that'll help you launder your money for a fee and move it from one place to another. So, tax avoidance, legal. It's legal ways to avoid paying taxes. Tax evasion, illegal ways of trying to avoid paying your taxes. All right, so again, these words: excise is imposts and duties. An excise tax is a tax that's placed on a good or service. So it could be a general thing like a sales tax or a specific item like the gasoline tax. Again, in Europe and many other countries, the sales tax is called a VAT, a value-added tax, and it's paid by the business, and you never see it. So Europeans will come to the United States and go, hey, what's this 8.2? Because to them, that VAT, that value-added tax, that excise tax should have just been part of the bill. It should have been included in the price from the company, and they don't expect to see extra. In England, the value-added tax is 21%. So we have an 8.25% sales tax. In England, there's a 21% sales tax. But the customer doesn't see it. It's included automatically in the price of things as that thing is produced. Okay? So different kind of world is value-added tax. The founding fathers intended that the U.S. government be paid for by excises and tariffs, imposts and duties. So they did not expect the U.S. government to use income taxes. They did not expect the U.S. government to tax property. They expected there to be excises and tariffs, and that most of the funding for the government would come from tariffs. And in fact, over time, most of the funding from the government did come from tariffs. Tariffs, excises. And again, I'm not including fees in this. And if you've been to, Yellowstone Park, you have to pay a fee to get in and use the campground. So there's fees the government charges, the federal government charges. And again, we'll talk about Nevada later, but Nevada obviously has lots of fees. You pay a fee for your driver's license and a fee to register your car and a fee to go to UNLV. So governments charge lots of fees. The federal government doesn't have a lot of fees in its budget relative to cities and states and those things. And then again, we have these imposts and tariffs. There are imposts and duties, rather. We would call those tariffs in the modern day. They're taxes on imports. So again, as we're living right now, there's a tariff war going on between us and China. We put tariffs on a bunch of stuff that they were sending here, like steel. We raised the prices of steel. Last year, 2018, the prices of washers and dryers on average in the United States rose over 20%, and that's because we put tariffs on the steel that's used to make washers and dryers, because mostly that steel was coming into the United States from outside the United States. At the same time, then China put tariffs on soybeans coming out of the United States, and in December of 2018 and November of 2018, where soybeans is actually the largest crop grown in the United States, and China was the largest customer of our largest crop. Exactly 0 soybeans were sold by American farmers to China. So tariffs, as we'll see, as we'll talk about, have a significant effect on economic activity. And they're intended to be a primary source of revenue, and they were generally the number one source of revenue in the United States. So, how do we go about paying an excise or sales tax? Well, there's two parts to this. One is this thing called nexus. Nexus is a fancy word for connection. Historically, businesses couldn't collect taxes from you unless there was a physical connection between you and them. So, if you were in Nevada and you were buying something through the mail from a company in New York, there's no sales tax unless that company in New York has a physical facility or employees in Nevada. Now, Nevada passed a law that says you're supposed to come in and pay them a sales tax, but nobody ever did. The Supreme Court has now said that the internet kind of creates a universal nexus. So when you buy something over the internet, your state can tax it now. So if you buy something from Amazon actually has a physical presence in Nevada. So Amazon has nexus with Nevada, and if you buy something from Amazon, you should normally pay tax on it because there's a physical nexus. But even if you weren't buying it, or if you're buying something online from another state that doesn't, where the business just operates in one state and doesn't have any physical nexus because of the internet, now you're supposed to pay sales tax to Nevada. Okay? If you ever buy a car in California, I bought my last car in California. When you come in, you don't pay sales tax on it in California. California exempts you from sales tax because you're not going to register it in California. They give you a travel permit to drive your car back to Nevada. You drive that car back to Nevada. When you go to DMV to register it, you get to pay the sales tax on it. One big lump sum. One note to this is that the business that charges you that sales tax gets to keep a part of that sales tax as a fee for collecting it. It's not usually very much. It's 2 or 3% of the sales tax. I don't mean 2 of the 8. I mean if you pay $100 in sales tax on something, if you buy something expensive and you end up being charged $100 in sales tax, $2 or $3 of that, right? So if you pay $1 on sales tax, 2 or 3 cents gets kept by the business. Okay? So not everybody has to pay sales tax, and not everything gets charged sales taxes. In one of the most famous Supreme Court cases of all time is McCullough versus Maryland, and we'll talk about that more when we talk about money, is 1819. But one of the important things that McCullough versus Maryland did was basically say that in our federal system, one level cannot tax the other levels. So the state of Nevada cannot tax the federal government. State buildings don't have to pay property tax. UNLV is mostly exempt from federal tax. I, as a state employee, don't have to pay Social Security tax. Different levels of government are exempt. If you buy a state bond, if you buy a Thomas and Mack bond, a financial instrument that's issued by the state of Nevada, there's no federal income tax on the revenue from that state bond because that one level of government taxing another level of government. And beyond that, states don't tax everything. So the state of Nevada does not tax food you eat at home. The state of Nevada does not tax medical expenses. The state of Nevada does not tax labor. If you get your car fixed, you have to pay tax on the parts, but not on the labor. In some states, you have to pay tax on everything. You don't pay tax on your apartment rent, etc., etc., etc. So the state exempts big parts of your spending from having to pay a sales tax, and in doing so, it makes the sales tax less effective. And we'll talk about that when we get to Nevada.